Hey, good afternoon and welcome back everyone to our special session to kick off 2024's Q4 earnings season. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay and um, another earnings season kicking off. It seems like we were just at earnings season last quarter, just a short while ago, but a lot has changed here in regards to what markets expect for this upcoming season. The bar is set pretty high versus last season, which the bar was set pretty low. So it'll be really interesting to see how we play out, and that's certainly going to have a pretty substantial uh shift in terms of sentiment based on the outlook for or based on the results of this earnings season's results. So let's take a look at kind of where we currently stand and what our views are. Now, every single Thursday, we are here dedicated to help you learn how to sustainably and confidently grow your account over the long run. And that means making sure that you have access to the content that you need to help you better understand both option strategies, but also things around technical analysis, fundamental analysis, how to go about navigating earnings season, even trading psychology and mindset are important things that we try to cover on these Thursday education sessions. So if you're joining us for the first time, please chime into the chat windows. You can see quite a few of you have already chimed in and said hello. Please say a hello, tell us where you're from. As you can see, we have a very diverse audience from all over the world. So please introduce yourself if you're joining us for the first time and make sure that you come back here every single Thursday to help you get the education that you need to confidently grow your account if you are not already there. Now, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using as example purposes during today's session. So we'll be covering kind of what Q4 earnings preview currently looks like. We'll also talk a little bit about what Q3, the previous quarter's earnings, turned out to be like. We'll take a look at what are some of the best and worst sectors going into this particular earnings season. I want to talk to you about the earnings calendar, which is arguably one of the most important things to help you navigate this upcoming earnings season, especially when it comes to options trading, kind of figuring out which symbols to research so that you can potentially trade an option strategy on the back of it. And then I want to walk you through kind of how you want to think about a specific symbol and the research that you want to do in order to make a trading decision. And then we'll go through some live examples and the optimal option strategies that you might want to deploy during earnings season. Now, the primary thing I want you to be able to walk away from today's session is a clear understanding as to how can you trade earnings season with confidence and maximize your returns around this type of volatile time, and how can you harness that volatility? Because sometimes earnings season can seem a bit scary because of how much movement there is in each underlying stock in such a short period of time, but we want to make sure that you have the tools to help you navigate that volatility going forward. Okay, so I already saw a few questions here in the chat window asking, will this be recorded? So yes, not only will this be recorded, you will get access to the slides. Simply sign up for a free trial, or if you're already a member, you'll get access to that on Sunday, which is when we typically post these recordings on our YouTube channel. You can sign up for a free trial by simply pointing your phone to that QR code or clicking on the link in the chat window. It takes literally 10 seconds to set up, and you will have access to both the recording, the slides, as well as the tools that I'll be showing you during today's session to help you navigate earnings season, especially around the tools that you can use to structure the options trades that we'll be discussing during today's session. So, sorry. So let's talk a little bit about kind of what our expectations are for the previous quarter and what our expectations are for this upcoming quarter. So if we look at last quarter, we saw EPS grew by about 5.9% year over year versus the expected 4.2%. So we did exceed kind of earnings expectations prior to going into the earnings quarter. But as you can see, 4.2% is certainly on the lower end in terms of expectations. So the bar was set pretty low. We did manage to exceed that bar, but not by a whole lot. So that's one thing to be aware of. Revenues increased by 5.6% year over year versus 4.6% that was expected. So both of those bars, I would say, were set relatively low. Margins came in line with expected. Net margins were about 12.2%. And then when we look at the sectors, the two best performing sectors on earnings last quarter were communications. 95% of communication stocks beat their top and bottom line. 86% of tech beat their bottom line earnings numbers versus materials and utilities had the worst. 46% of material stocks missed their earnings, and 32% of utility stocks missed their earnings expectations. So this is really where we saw a pretty good earnings quarter that, based on the fact that the bar was set pretty low. So a lot of stocks managed to beat their earnings expectations. And what was interesting is that the stocks that beat on earnings did move a sizable amount higher, 1.6% on average. But stocks that missed on earnings actually was down about 2.9%. So a pretty substantial skew in terms of underperformance on stocks that missed on earnings. And that was partially also because the bar was set pretty low. If you missed on earnings, we saw stocks get beat up pretty badly on that versus stocks that beat on earnings. When the bar was set so low, you don't have as much movement here to the upside. So if we look at kind of looking at this upcoming quarter, right now, expectations going into this quarter are quite high. Notice how previously, the previous quarter, we were expecting 4.2% year over year growth in terms of earnings. We're now expecting 11.7% year over year growth in terms of earnings. So the bar has been set much, much higher here for this particular quarter. Revenue 4.6% in line with last quarter. And then when we look at kind of what sectors had the largest revision ratios, meaning which sectors saw analysts revise their expectations for this companies in that particular sector higher versus lower, right? So where do you see sectors where there are more revisions higher, and where do you see sectors where there are a lot more revisions lower? So financials and utilities were the two sectors that saw the largest upward revisions, and we've seen some of the banking stocks so far off to a pretty good start. You have JP Morgan, Goldman Sachs, Bank of America, all reporting really great earnings, and we've seen those stocks rally on the back of that. On the flip side, energy and materials have the worst revision ratios going into this earnings season. So we haven't seen any reports in those particular sectors, and we'll see kind of how those play out as they come along. But those are kind of the sectors where analysts are getting a lot more bearish in terms of their views as they head into earnings season. So when you look at kind of where we currently stand, the S&P 500 is trading at 21 and a half times forward earnings. Now, that's a pretty substantial premium over the 10-year average, which is around 18.2. And this is definitely something I think is weighing on some investors' mindsets right now, especially with interest rates, 10-year yields back at about 4.6%. That's providing some major headwinds for equities. And then when you couple that with the fact that we're trading at some of the richest valuations we've seen in over a decade, that's really kind of some of the concerns that a lot of investors have right now with the market environment that we're in. So it is a challenging environment that we find ourselves going into this particular earnings season. 77% of early reports, meaning reports that have reported on the S&P 500 so far, have beat on EPS, but only 59% have beat on revenue. So 77% of reports beating on EPS is pretty much in line with average. 59% is below average in terms of the number of stocks that are beating revenue expectations. And from my perspective, revenue expectations are more important because you can't manufacture revenue. You can manufacture earnings. You can basically reduce spending to manufacture better earnings, but you can't do that for revenue. So, I pay a very close attention to kind of what percentage of companies are beating on revenue, because that gives you a better sense for the health of the overall economy. Now, this is based on very small sample size of data, so I wouldn't put too much weight behind this just yet. but even stocks that beat on earnings on average move lower by 1.8%. I do think that with the financial stocks coming in, that is going to flip back to a positive number, but misses so far down 8.7%. Again, that's off of a very small sample size. So I'm not putting too much weight on those numbers just yet in terms of the earnings season. But as we go through the next week or so, as we get more stocks reporting earnings, what performance stocks actually have on the back of beats and misses are going to play into our views as far as what which direction has a probability edge when we're trading this particular earnings season. So if you look at last earnings season, misses down 2.9% versus beats up 1.6%. What that's showing us is that, when you took bearish opportunities, you had a much larger move to the downside where the risk reward skews more favorable to the downside than on bullish plays. So at the moment, that is the direction that this quarter is trending in as well. And I'll be honest, I've never seen early report numbers skewed this far. I don't think I've ever seen misses down 8.7%, even early in the season. So, that's really something to pay attention to. I think that this might be a quarter where you see stocks that miss make big moves here to the downside. So keep that in mind, and as you approach earnings season. So one of the most important things, in my opinion, to help you navigate earnings season is a proper earnings calendar. And that's what the OptionsPlay earnings calendar provides you with. This is something that you can find on the OptionsPlay platform. So if you have access to OptionsPlay, either through a free trial or if you're a member, you have access to the earnings calendar. And this is really, in my opinion, probably the most important thing that you need to help you navigate earnings season, because if you pull up Yahoo Finance, you pull up an earnings calendar at your broker's platform, you pull up a specific date. Let's say we look at the 22nd of next week, you're going to find hundreds of symbols that report on a given date. And a lot of times those earnings calendars are sorted based on alphabetical order, which is not a particularly good way to go through a few hundred symbols to figure out which ones you want to research, especially if you want to trade options on them. So what we do is we rank kind of, or sorts rather, the symbols that are reporting on a given day based on options liquidity. Because if you're going to trade options on something, you better know something is liquid before you go and do all the research on the technicals and the fundamentals. You don't want to do all that research and then pull up an options chain and say, oh, you know what? There's not enough liquidity on these options. I'm not going to be able to trade it around earnings season. So especially around earnings season, when volatility tends to be higher, you want the flexibility to be able to get in and out very quickly. So you want something that's very liquid. And as you can see, even on some of the big days, right? Even on some of the days, like for example, January 30th, even on a big day, there's only about a dozen or so, 2 dozen, or on the high end of what we consider highly liquid stocks that you might want to trade options on around earnings. And what that does is it helps you sort through the hundreds of symbols on a day that's on a stock that's reporting on a given day to know where do you want to focus your research on. So as we head into today's the 16th, as we head into kind of the 17th and early next week, as we head into next week, I know what stocks I'm going to spend my time researching on. It's this handful of stocks. I don't have to care about, the other 2 dozen stocks that are reporting on that given day, because I only want to trade options on these. This helps you navigate your earnings season. And so anything that's in green that has a score of 1 next to it, these are the most liquid stocks that are reporting earning on that day. Anything in yellow means these are somewhat liquid. So, if you kind of exhausted your list in the first that are very liquid, and then you want to look at something that's maybe somewhat liquid, just be a little bit more careful on those. But anything that has a score of 3 that's not colored, those are the ones that you want to stay away. Those do not have liquid options. You don't want to trade options on these particular stocks. So if you typically want to trade options on earnings, you don't want to spend your time researching those stocks, because you won't be able to execute an option strategy easily on those specific stocks. So as I look at kind of the 21st, the beginning of next week, this is Tuesday because Monday's a market holiday, you have DR Horton, you have Fitbit, you have KeyBank, 3M, Sherman Williams, you have COF, which I believe is Is that Capital One Financial? Yeah, and then Netflix, Seagate, and United Airlines, right? So those are the stocks that I would spend my time researching. And on top of that, what we have are, as you can see, the top five have an asterisk sign next to it. Those are the ones that report in the morning. The ones without the asterisk signs are the ones that report in the evening. So what that even allows me to do is segment, okay, if I'm looking at this over the weekend, or maybe if I'm looking at this on Friday, I'm going to research these five stocks because those are the ones that I could potentially place a trade before the close on Friday and be able to, have that play on Tuesday morning. Versus on Tuesday during the day, I'm going to research perhaps these four stocks because those are the ones I can put on a trade right before they close and potentially have an options trade that's going to allow me to capture the volatility of that earnings for that specific day. So what this helps you really do is, again, on any single time that you're trying to navigate earnings season, we're trying to limit the amount of symbols that you're researching to a very small handful of stocks. So you're not overwhelmed with the hundreds of symbols that are available to you, that are available to you here at on a given day. So, like I said, by far, this is the only earnings calendar that I will use I've used lots and lots of earnings calendars out there. There's lots of them out there. They're all available for free too. But they're, from my perspective, useless if you're just listing a 300 stocks by alphabetical order. I'm not going to be able to go through that quickly to figure out which ones I want to do my research on. This one allows me to do that very, very quickly. Okay. So this is available to you on the OptionsPlay platform. So if you log on to OptionsPlay, you can go to the hamburger menu on the upper right-hand corner. If you click on that hamburger menu, there is a section here for earnings, and that is the earnings calendar. That will take you directly to this earnings calendar that will provide you with the insights that I'm showing you here during today's session. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. And I know many of you that have been trading with us for a while, you've probably used this a lot, but for those of you that are joining us for the first time, or if you're new to OptionsPlay, this is one of the, arguably one of the most important tools that we have for you to use around earnings season, okay? Perfect. Okay, I see a lot of ones. Great. Let's see. All right, so now let's talk a little bit about earnings research, right? So now that we have our earnings calendar, we know kind of on any given day which handful of symbols we want to research. Here's how I go about thinking, or here are the things that I look for to decide whether this is a stock that I want to take either a bullish or bearish view on going into earnings. Occasionally, I might take a neutral view, but for the most part, I'm trading stocks that I think are going to either potentially make a big move to the upside or a big move to the downside. So there are two things that I look for from a technical perspective, and that's absolute strength and relative strength if I'm looking for a bullish setup. And I'll talk about absolute weakness and relative weakness for bearish setups next. So here's Boeing, right? We recently picked Boeing in our trade ideas list. This is something that we publish every single Monday and Thursday. For those of you that have either a free trial or a membership, we publish our bull and bear list every single Thursday. Boeing has been in our bull list for a few weeks now, and this is the type of stock that we typically like to look for going into earnings season. And Boeing, I believe, reports in just under 2 weeks' time. Basically, what you want to see is a stock that's exhibiting absolute strength, and what that means is that we're making higher highs and higher lows, and perhaps even breaking above resistance levels. And especially if it pulls back to support, that's really kind of where your risk to reward is most favorable to look for kind of that type of breakout or type of catalyst where earnings could push this stock higher. But just seeing absolute strength, meaning strength of this, a chart moving higher, making higher highs and higher lows, and kind of breaking above resistance, that in itself, from my perspective, is not enough because what you want to see in addition to a stock breaking higher or trending higher is that you want to see that the market sort of agrees with that and is accumulating this stock faster than they're accumulating other stocks, right? With the advent of passive investing and the fact that we have more money being managed by passive investing than active investing, When markets go up, all stocks go up, right? So, you don't want a stock that just simply moves up because every other stock is moving up. What you want to do is you want to buy stocks that, institutional investors and everyone else is buying at a faster clip than they're buying the rest of the market. And that's what we're seeing here with Boeing, right? Not only has it broken out above that 160, 162, 165 resistance level and come back to retest that support, but during that time, it's actually outperformed the S&P 500. So, what you want to see is that not only is the stock trending higher, you want to see stocks that are outperforming the S&P 500 at the same time. And when you get both, that's really when you're skewing the probability of a bullish move on earnings in your favor. Does it guarantee that the stock's going to beat earnings and move higher? Absolutely not. But what you're trying to do is you're trying to find evidence that there is a stronger support, that there is institutional buying, that there's that investors are buying this particular stock faster than they're buying the rest of the broader markets. And that's exactly what a relative strength indicator gives you the ability to understand. On the flip side, if you look at a stock like Netflix, this is the stock that we recently put on our bearish list. This is kind of what you see of absolute weakness, right? So what we have is you can call this a bit of a topping formation if you want. You could potentially call this a head and shoulders top. But what we're starting to see here are lower highs and lower lows, right? And especially when you break below support and you come back to retest this as resistance, that's really where your risk reward is most favorable for adding some bearish exposure. But, if it's moving down with the rest of the market, that's not enough evidence that this is a stock that's going to miss on earnings and decline on the back of that. But when Netflix is being sold faster than the rest of the market, that's really kind of evidence that, institutional investors heading into the earnings announcement are dumping this stock. They're not continuing to buy the stock the same way they're buying the rest of the market. They're dumping the stock perhaps at a faster rate. Those are some of the signs that perhaps earnings might come in a little light, might miss on earnings, and you might see a move to the downside. So I always look for both absolute and relative strength in order to have the confidence to pull the trigger on a bullish or bearish view going into earning season. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. And someone asked, would you compare the stock to its sector? You absolutely can and can do that as well. That is another common thing that you can do is instead of comparing a stock to the market, you can compare a stock to its sector. You typically would like to see the same type of evidence as well. So, for example, if you do see a stock that's outperforming, is trending higher, is outperforming the market, and it's outperforming the sector, that's even more confidence that you could potentially have going into an earnings event, and vice versa. If you have a stock that's bearish and it's underperforming both the market and its sector, that would further give you, even more confidence that you could have a stock that will miss on earnings and potentially move substantially lower. Now, I will say stocks that are trending higher and outperforming the market and outperforming the sector don't happen very often, right? So throughout an earnings season, you won't find too many of them, but the ones that you do, that's really kind of where I like to trade those. And that goes back to our earnings calendar because it takes so much time to find these. The only way you can do that is if you have a small list to look at, right? If I only have 5 stocks to look at for today, I can probably look through all 5 stocks, look at how they're performing relative to the market, how they're performing relative to the sector, and maybe I'll be able to identify those stocks heading into earnings season. So, yes, earnings season is a very busy time. It takes a lot of diligence and effort and commitment to kind of look at these specific stocks on every single day. You have kind of 2 potential opportunities, one in the morning, one in the afternoon, to potentially trade these earnings seasons. But so there's a lot of stocks to look at. We're talking about thousands of stocks that are reporting. That's why this earning calendar is built for you, so that you only have a small handful of stocks to look at each day, so that you can potentially try to identify these best opportunities for that given day. Okay, so once you've kind of done your technical research, right, where you're looking for stocks that are having absolute and relative strength or absolute and relative weakness, then we have to look at fundamentals. We have to look at valuation. We have to look at profitability. it's important to understand how companies generate their profits and income. A lot of times, I do find that a lot of technical traders, what they'll tend to do is they'll trade stocks just on the back of, this thing's broken about a 50-day moving average, and they know absolutely nothing about the stock, what sector it's in, what business they're in, whether they're profitable or not, how they make their money. And I can't stress enough how by not understanding those things, you can potentially, you can make a lot of mistakes, right? Where, the chart from a technical perspective looks well, but, if you had just known a little bit about their business, you might have said, hey, this doesn't seem like the right environment for this type of business to strive, right? Or, for example, luxury goods in this type of market environment where consumers are being a lot more selective of their spending may not be the best timing for those types of trades. Vice versa, if you're looking kind of like dollar stores, those are the best times, when things are getting a little tough, when inflation is still an issue for a lot of people. Walmart, dollar stores, those are the ones that tend to do a little bit better. So just some common sense many times can help you avoid some costly mistakes. So it's really important that you understand how a company makes their money, understand a little bit about their valuation. And I'm not talking about having to do deep dive fundamental research, but just back of the envelope, common sense, right? Is this company growing fast? Is this company profitable? How profitable it is it relative to kind of the stocks in its industry, and what is the valuation that's trading at? Boeing growing much faster than the rest of the industry. It's not profitable at the moment because of some obvious reasons, but as they focus on profitability towards 2025, and we do expect it to turn a profit in 2025, if you look at their growth rates and you look at their valuations, Boeing's trading at the cheapest valuation across the entire industry. That's why I think it's an early potential it's an early investment, right? It's early in its turnaround, right? A lot of people don't quite believe in it just yet, but that's kind of the speculative nature of trading, and that's why I'm taking a bullish view here on Boeing. A lot of people don't agree with me, but I do think that you have a good CEO coming in. They're seemingly making the right moves in terms of a turnaround, and I could potentially be wrong on my timing. But we do see the early stages of, from a technical perspective, some interesting strength that we haven't seen in many, many years, that we're just seeing for the first time. And you have growth that is truly outperforming its sector, and it's a valuation that's much cheaper than its sector, and that gives me that upside potential. And if you look at Netflix, the exact opposite. Netflix is trading at a valuation that's far richer than any of its peers. Yet, if you look at growth rates and profitability, it's not as profitable as some of the more profitable stocks in its sector, and the profit margins continue to get squeezed at Netflix. So those are some of the things that are concerning to me when you're trading at such high valuations and you're starting to see that growth slow down. Those are some of the concerns that I see. So having a better understanding of just the basic fundamentals, how they make money, how much money do they make, how fast are they growing, that's going to help you just do some back of the envelope, common sense things of like, hey, this valuation makes sense, or this valuation doesn't make sense. I'll give you an example. Apple trading at 32 times forward earnings, only expecting to grow EPS at about 10 to 12%, revenue under 10%, and net profit margins of about 25%. Trading at 32 times forward earnings sounds way too high when you consider stocks like, let's say, Visa growing at the same pace, net margins that are 55%, yet it trades at only 27 times forward earnings. That makes a lot more sense to me as an investor versus 32 times when you're not as profitable and you're growing around the same pace. Doesn't make sense when those two are trading each other. And look at just Apple versus Nvidia, right? Nvidia grows hand over fist faster than Apple, is far more profitable than Apple, yet it trades at a cheaper valuation than Apple. So, these are just common sense things that you'll start to understand if you just look at those two primary metrics on every single earnings or every single company that you evaluate, is how fast is it growing and how profitable is it, right? And if you look at just simply just a forward PE ratio, you'll quickly get a good sense for, hey, this makes some sense. This doesn't make sense. This seems like really cheap, or this seems really expensive. And you'll quickly get that feel if you look at those three metrics. with each earnings season. So those are some of the things that I look at with each earnings season. Those are some of the things that hopefully you have learned how to look at by viewing kind of our Monday morning sessions, which what I go over every single trade idea in our bullish and bearish list every single Monday. And I walk you through the technicals, I walk you through the fundamentals, I show you the valuations, the growth story, and the profit margins, and why certain stocks I find undervalued, which stocks I find overvalued, and hopefully, that helps you better understand how you can do that same analysis on your own when you're going through earnings season. Does that make sense, everyone? Please type three into the chat window if that makes sense to you. And I see a lot of people asking some questions and some people actually answering those questions. So thank you so much for those of you that are chiming in and helping other investors. So again, if you're brand new here to Options Play, you see that we have a vibrant, supportive community. Please, I hope that you join us every single Thursday on these sessions, because that's my goal, is to help you all grow your trading accounts. Perfect. Okay, so let's talk a little bit about strategies. So once you've identified a stock, like for example Boeing, right, where I think the technicals align quite well from both absolute and relative strength perspective. You have a valuation that's nearly 20% cheaper than the industry, yet it grows faster than the industry. It's not as profitable. It's not profitable right now, but we do expect in 2025, it's going to turn a profit. So, I am a little early on this. It is a little bit speculative, but that's one that I'm willing to take, especially utilizing options, because I'm reducing my overall risk when I take an options trade versus if I were to outright buy the stock. So when we think about option strategies on stocks that you think can make a big move, those are the ones where I prefer a debit spread. And I specifically prefer the 3x1 variation of that spread. And I'll walk you through what I mean by that. So, we trade debit spreads a lot here at Options Play, but we typically trade a slightly in the money debit spread. We usually go about 60 days out. But when it comes to earnings, we usually go a shorter dated expiration. We'll go out typically no more than 30 days. And that's because we don't plan on holding on to this trade for more than a couple of days for the most part, right? We just want to make sure that for the few days that we hold on to this trade, we're paying relatively minimal time decay. That's why we're going out 30 days versus going out 7 days. Because if you trade a 7-day option and you're holding it through 2 days of earnings and you have volatility crutch, you're losing quite a bit of time value of that 7-day option. But if you buy a 30-day option, the time value that you're losing over those couple of days is much smaller. So it's really important that you use a longer dated option, even if you only intend on holding that trade for just a few days. And the 3x1 variation means that what we're doing is instead of buying an in the money call or put, we're buying a slightly out of the money call or put. We're buying a 40 delta call or put, and then we're selling a 16 delta call or put against it. And that allows us to basically have a debit spread where you are paying roughly 25% of the width between the two strike prices. If you pay 25% of the width, that means 75% of the width is going to be your potential gain versus 25% is going to be your total loss or risk that you're taking. So 75 versus 25 is a 3-to-1 risk to reward ratio. That's why I call it a 3-by-1 variation of a debit spread. So, when you're looking at Boeing here, I'm going out to the February 14th weekly expiration. That's the one that's about 30 days out. If I'm buying that 170 call option, which is the 40 delta call in this particular instance, and I sell the one standard deviation out, which is 185, that cost me about $4.09. On a $166 stock, that's around 3% of the stock's value that I'm risking. And as you can see, I'm risking roughly $400 to make roughly $1,100 on that particular trade. So that's not quite 3-to-1, but pretty close to 3-to-1 in terms of risk reward ratio. You might not always get exactly 3-to-1, but this is sometimes as close as you get. But that's kind of the type of risk reward that I want to see on earnings, because if I'm right on this particular view, I want to make sure that the amount that I'm potentially making is orders of magnitude higher than what I'm risking on an earnings play. Because earnings season, you don't have to get a lot of these trades right when you structure trades like this, right? You could be right less than 50% of the time and still come out profitable out of earnings season, because you're only trading setups where if the stock makes a big move, you're getting paid 3-to-1 on that risk to reward ratio. And those are the types of structures that I really like around earnings season, because only earnings season gives you that opportunity where the stock can make a quick move in a day or two, and you can turn kind of what is a 3% risk on the underlying stock's value to a 10% gain in the stock's value, or roughly a 3-to-1 risk reward ratio on the investment that you have at risk on the specific trade. So this is a go-to strategy for me when I expect the stock to potentially make a big move. When do you expect stocks to make a big move? Stocks that have relatively, um, relatively, um, what's the right word? Relatively undervalued by pretty significant margins. So, for example, if you look at some of the ideas in our bull and bear list, I think Nvidia is a pretty good example of stock that's significantly undervalued. You look at Shopify, it's significantly undervalued. What are stocks that are overvalued? Apple is a good example of stock that's significantly overvalued. Tesla's significantly overvalued. Netflix is significantly overvalued. So stocks that, where if you look at kind of the growth metrics and the profitability, and you look at other stocks in this industry and you see that other stocks are trading at 20 times earnings, but this one's trading at 30 times earnings, even though the metrics don't look very different from the other stocks in its industry. Those are the ones that you want to look out for, because those are the ones that could potentially make a big move on earnings. When a stock is substantially overvalued or undervalued, those are the types of stocks that can make a big move. We've seen big moves in Shopify, we've seen big moves in Disney, we've seen big moves in Lululemon. These are all the ones that we've recently pointed out last earnings season that were significantly undervalued. And those were the stocks that made 10, 15% moves on earnings season. And those are the ones that you want to look for, these types of debit spread structures for your trades. Does that make sense, everyone? Please type forward to the chat window if that makes sense to you. Perfect. Okay, so now there's not many stocks that you will necessarily go into earnings season, find kind of the technical setups, and at the same time find that they are significantly overvalued or undervalued. Those are kind of pretty rare. They're there, but they don't happen very often. On the flip side, you might find many times where you find the directional, from a timing perspective, from a technical analysis perspective, you like, but from a valuation perspective, they're pretty much in line with what you would expect, right? Because a lot of stocks, you don't tend to have a lot of stocks that are significantly overvalued or undervalued. You might have stocks that are modestly overvalued or undervalued. And in those cases, what you are more perhaps your view is that, the stock's going to move in one direction, but maybe you don't expect it to move huge, like 5, 10, 15% moves overnight. You might want maybe on the lower end, maybe that 3 to 5% move for stocks that are, sort of fairly valued for kind of their growth and profitability. And that's really kind of where I turn to selling credit spreads. Selling credit spreads are a strategy that you can use whenever you just have a general trend in an overall stock. So Arista Networks trending higher here recently broke out the new 52-week high, has outperformed the S&P 500 over the last 6 months. Has all the criteria that you're looking for from a technical perspective, but from a valuation perspective, Arista Networks is on the high end. It trades at something like 38 times forward earnings. So it is already high. And for those types of trades, I prefer to be selling options and taking advantage of that volatility. So when we're selling a credit spread, we usually go out 45 days. That's the February 28th expiration. And we'll sell an at-the-money call or a put. Because this is a bullish trade, I'm going to sell the at-the-money put option, which is going to be the 116 put when the stock is trading at 116. And then I'm going to buy an out-of-the-money put option against that at 25 delta, and that's the 106 put. So that's a $10 wide credit spread. And what you want to collect is at least 1/3 of the width, right? So if it's a $10 wide credit spread, you want to collect at least $3.33, because if you collect $3.33, then the rest of the $10, $6.67, is going to be your total risk. The more you collect, the less risk you take. So you always want to trade credit spreads where you collect as much income as possible, because that's going to reduce your risk on the overall trade. So in this particular case, I'm going to collect $4.10 versus the $3.33 minimum. So I'm collecting 41% of the vertical width. That means I'm only risking 59% of the vertical width. So by skewing that risk to reward in my favor, I'm going to increase my probability of success on these types of trades. So this allows me to potentially risk 590 to make 410, and my risk reward ratio, as you can see, is slightly negative, but this has a very high probability of profit because as long as Arista Network stays above 111 and the stock is currently trading at 116, as long as it stays above 111, I'll be profitable. So even if the stock basically moves in the wrong direction, as long as it stays above 111, I'll be profitable. And that's the forgiving nature of these types of strategies with a negative risk reward ratio, is that you can be profitable in a lot of different scenarios. If you're right, you'll be profitable. If the stock doesn't move, you'll be profitable. If the stock moves a little bit against you, you can still be profitable. Only if the stock makes a big move against you do you lose more than what you can potentially make. So that's the trade-off that you're making between debit versus credit spreads. One is not better than the other. It's just a matter of what your outlook is on the specific stock that determines which particular strategy you might want to deploy. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. Okay. That is what I wanted to share with you here today. Earnings season is an exciting time. It is a lot of volatility. It is a lot of research and time commitment to do that research every single day. But hopefully what I'm able to do here today is help you understand which symbols should you pay attention to on a given day and how should you look at those symbols to identify which ones you can potentially make a big earnings play on that given day. And once you've identified that, structure the right options trade for your specific outlook for the specific stock. So with that, before I open this up for Q&A, or I'm going to open this up for Q&A, but for those of you that want to sign up for a free trial to OptionsPlay so you can get access to the earnings calendar, you can get access to the OptionsPlay tool that will help you structure those debit and credit spreads. That is available to you completely free of charge on the link on your screen, or you can point your phone to that QR code or click on the link in the chat window, and that will give you access to the specific symbols for the earnings calendar and give you access to today's recording and slides. Now, I did see a question here before about, how do you know which sectors are in, or which stocks are in which sectors? Well, we have a sector watch list here. So under the watch list section, we have global watch lists for each individual sector. So for example, if you look at kind of the financial sector, right, we see there are 72 stocks, and these are the 72 stocks that are in financials in the S&P 500, and we have a list of them. I usually like to sort it based on relative strength so that you can quickly see what are the stocks that have the strongest strength, what are the stocks that have the weakest strength here, just by a click of a mouse. So we have all the sectors listed under our watch list, so you can find the sector that you're interested in. Let's say you're looking at consumer staples, so you can see Pepsi, which is one of the stocks that we just put into our buy list earlier today, is on this particular list. It is also kind of very early days, kind of a turnaround story. A lot of people look at the stock and they're saying this looks very bearish. Well, I think the stock has sold off so much that the valuation looks incredibly compelling for a move here to the upside. So that's an example of how we utilize these tools to help you identify specific symbols and then structure options trades on the back of that. So let's turn over to the questions. There's a Q&A window here at the bottom of your screen. I see there are over 20 questions already, so let's get right into helping you answer some of those questions. What about buying or selling the day before earnings and at the money straddle 45 days till expiration? Well, I would say buying and selling a straddle are very, very different strategies. Buying a straddle, I would not recommend going into earnings season. Selling a straddle is something I could recommend if you have a relatively large account, you know exactly what risks you're taking with that specific strategy, and that specific stock has a relatively high implied volatility, and you don't have a strong directional view. Then you might want to sell a strangle or straddle. I prefer selling strangles versus straddles, but I definitely would not consider buying a straddle or strangle because that is in the long run a losing proposition. Does all of this get included in the options play score? The options play score is looking at the risk to reward ratio of the specific strategy and the probability of profit. Those are the three metrics that the options play score is looking at. So if you look at a specific strategy of match risk, match reward, and probability of profit, it gives you a sense for how well balanced these things are. And we specifically built it because, if you look at this, right, the max reward is unlimited. The max risk is $14,650, and there's a 50% probability. Or if you look at this, unlimited max reward, $605 of potential risk, and it's 36% probability of profit. So, how do you actually gauge the risk to reward on something that has unlimited risk or unlimited potential profits? And that's why we created the options play score, so that we can give you a better gauge for risk to reward and probability of success. Undervalued via fundamental research helps me with investing more than trading. Yes and no. I would say that by not understanding the fundamentals in your trading, you're missing a piece of the picture, and you can make some costly mistakes, right? And I can think of my early days where, sometimes I trade a symbol just based on technical analysis alone, not knowing anything about the company. And then after earnings comes out, I lose money. I dig into a little further into the company, and I realize, oh, if I had known how they made their money or what sector they're in or what they do, I probably would not have traded that going into this specific earnings season. So just some common sense like that many times will help you avoid some costly mistakes. But I generally find that when you do your fundamental research and you identify stocks that are severely overvalued or undervalued, those are the stocks that tend to make the big moves on earnings, because that's basically when the market basically gets it wrong. And the market gets it wrong sometimes, right? Well, I mean, just look at all the gaps that happen on earnings. Those gaps happen because the market gets it wrong. The market thinks, oh, this stock is only worth this much. All of a sudden, information comes out, and everyone's saying, oh, crap, it's worth a lot more, a lot less. So the only way you can figure that out, which stocks have a higher likelihood of making those big gaps, is by doing your fundamental research. How many days before earnings should you place your trade? I generally, if it's pure earnings play, I wouldn't trade it more than a day before earnings. Sometimes even day of. So if something reports in the afternoon, you could trade it, that same day and basically get out the next day or two. So generally speaking, these are ones that you hold on pretty relatively short time. Um, If you're trading directionally and looking at undervalued stocks, which can raise by 20% or so, why not buy calls instead of a debit spread? A great question. Why not buy call options instead of a debit spread? Because generally speaking, during our earnings season, calls are really expensive, right? And the thing about options pricing is that the option market is pretty good at pricing the expected move on an earnings. Meaning, if you look at kind of how often when stocks make a big jump, more often than not, they're making that big jump to the one standard deviation move. It's not very often that you see those big moves exceed that one standard deviation move. So when you're able to, let's go to Boeing, for example, right? I'll bring up that example. I was looking at buying that 171, I think it was 171.85 for the for the February 14th expiration, right? And let's just go back to the long call. Let's set up a February 14th 170 call option, right? So, those are the two options. Basically, the question is, why would you buy the debit spread versus the call option? So let's look at the P&L simulator, right? Let's say we believe the stock is going to reach that a 185 level, because that's the one standard deviation move for February. So if we look at February 14th, you see the one standard deviation move is 186. The option market is what's the right word? Surprisingly good at pricing kind of the expected move on earnings. So and that's why when I trade butterflies, I'll have the pointy bit of that butterfly at that one standard deviation, especially on earnings, because more often than not, the big move that happens, it happens around that one standard deviation move. So why do I use a debit spread instead of a call option? If the stock reaches that 186 price point, right? If I bought a call option, I'm looking at 138% return. If I bought the debit spread, I'm looking at 191% return. That's why I buy the debit spread, is because I want that higher return because I'm risking less. And by risking less, I can potentially make more. So great question. But hopefully that answered your question, Raju. Do you prefer stocks that have morning or after hours earnings? I don't have a preference. I really don't. But you tend to find that the big ones report in the afternoon, but I don't have a preference. What's the best day to buy or sell options for earnings? One day before earnings? Yeah, so usually one day, well, you have to buy it the day before if it's reports in the morning, but I'll usually do it either day of or the day before. What about strangles? Strangles is really the very deep end of the pool for earnings season. I generally don't think a lot of most traders should be trading strangles around earnings. I think you really have to be a fairly experienced trader. And if you are that experienced, you probably have already done a lot of your research in regards to how you want to sell strangles. But it's very much the deep end of the pool for people who have relatively large accounts to sell strangles around earnings. What's your take on time spreads or straddles? So time spreads are kind of like debit spreads. Time spreads are just like a variation of a debit spread. Just instead of selling a long dated call option or put option, you're selling a short dated call or put option to try to collect even more income, faster. So, time spreads work very similar to debit spreads in my opinion. And straddles and strangles, like I said, it's the deep end of the pool with regards to selling those around earnings season. How do you determine if call or put? Well, it depends on whether you're bullish or bearish on the stock. If you're bullish, you want to buy calls. If you're bullish, you want to sell puts. If you're bearish, you want to buy puts or you want to sell calls, right? So it's really based on what directional view you have. I saw a lot of questions around how many days before do you enter. Hopefully, I've answered your questions there. What's the best protection when expecting the crash of a stock that cannot be sold preemptively for fiscal reasons? Would a combination of selling in the money call option and buying a protective put make sense? So I'm generally not a big fan of selling in the money call options. I think if anything, you could sell an at the money call option because that's where you're going to collect the most premium, right? Because an uh, in the money call option has very little extrinsic value, which is the whole point of selling options. So I would sell, if you're going to think about getting very aggressive, sell an at the money call option and then buy your protective put. And I would probably look at buying a slightly out of the money protective put rather than an at the money protective put. Why would you not do a credit spread for Arista Networks? Well, that's exactly I did structure a credit spread for Arista Networks. So this trade here, this last trade, this is a credit spread on Arista Networks. I noticed that you go at the money as opposed to considering the expected move. Well, when you're selling options, it doesn't matter whether the stock moves, 1% in your favor, 2% in your favor, 10% in your favor, 1,000% in your favor. So it doesn't really matter, right? So the reason I'm selling an at the money call, credit spread is because I want to maximize the potential income and reduce the overall risk. It's really about skewing the risk to reward ratio as far in your favor as possible. How can an individual calculate valuations? You generally don't calculate these things anymore. Everything is done for you in this day and age. Most platforms will provide you with these valuation metrics already calculated for you. If you really want to learn how to calculate it, I'd say Investopedia is a good resource for that. Pros and cons of strangles versus credit spreads. Pros, strangles collect a lot more premium. Cons, strangles have a lot more risk. It's really a balance between risk to reward and the amount of income that you can rather, sorry, the amount of risk that you're taking versus the risk to reward that you're taking. When should you close the credit spread? So the rules for credit spreads remain the same, even though you're playing playing these around earnings, right? So we have a whole webinar on our YouTube channel, youtube.com/optionsplay, just on credit spreads. I suggest that you take a look at that one and see what the rules are. How can one use IV and HV to inform options trading around earnings? So, if you are trading earnings, you generally want to trade stocks that have relatively high implied volatility. Now, generally speaking, all stocks have high implied volatility around earnings, so there's really not much edge that you're getting there. But the stocks that have the highest implied volatility, I would say, have a slightly better edge than stocks that have low implied volatility. So you factor that in, but keep in mind that a lot of people think about implied volatility. The exposure that you get to implied volatility from an option is through the Greek vega. And if you think about like your exposure to vega, meaning your exposure to the changes in implied volatility, it's minuscule compared to your exposure to the underlying stock and exposure to time decay. So, yeah, it really is kind of um, doing yourself a huge disservice by structuring your trade around implied volatility when your exposure to implied volatility is relatively small compared to your exposure to delta or the underlying stock's position. So you should choose your strategy based on your directional view, not based on your volatility view. Because even if you get the volatility view correct, if you get the directional view wrong, you're going to lose a lot more money on the directional view than you're going to gain on that volatility view. So keep that in mind when you're thinking about this. When you identify stocks that are going to go on a run using options, I'm not sure I understand the question. Are you saying that can you use some type of option metric to determine which stocks are going to make a big run? I'd say that I wouldn't necessarily bet on that. I don't think there's anything that reliably from an options perspective will tell you whether a stock's going to make a run or not. I think the only thing that can potentially give you some sense of that is really fundamentals. What about selling the calls in the earnings week and buying calls 30 days out? Yeah, so that's a time spread, which is a variation of a debit spread. So it's just a more advanced version of a debit spread. It takes a lot more effort to manage those trades, but you can absolutely can trade those, and there's some marginal benefits to trading a time spread versus a debit spread. All right, I have time for one more question. How do you determine direction? The chart. The chart is really the chart, and some fundamentals, but really the chart is predominantly how I determine direction. You want a stock that's trending higher, the absolute strength, absolute relative strength. Those are the bullish stocks. Absolute weakness, relative weakness. Those are your bearish stocks. With that, thank you so much. I hope you guys have found this session useful. I hope that I hope everyone has had a healthy and happy New Year. If I haven't seen you since the holiday season, and I hope that this gives you a good sense for how to navigate the upcoming earnings season. So far, banks are off to a really great start, so hopefully that can continue and we get some good trades this earnings season. Thank you so much. Have a great trading day.